Hi, welcome to the CFO Squared podcast, chats about financial and financing optimization. I'm Karl Baker. This podcast is all about business funding, success, and strategy. We're here to help you know how to finance your business. We will also talk about other financial issues impacting your business and ideas to help you succeed and advance your cause. Now let's get into the next episode. Hi, everybody. Karl Baker here again, and it's another episode of CFO Squared, chats about financial and financing optimization. I've been looking forward to this episode. It's been on my mind a lot lately. And I just want to talk. I talked in the last episode about some real estate financing considerations, real estate investing considerations, introducing the concepts of lending considerations, the different types of real estate that you can invest in, and how lenders view some of those things. It was kind of high level, and I could spend even more time looking at some of those in a little more depth. If I get some feedback from listeners that they would like some of that, then that would be great. And I would be happy to do that. But wanted to do a little bit of high level analysis on that. In this episode today, I want to talk to beginning residential real estate investors. Beginning residential real estate investors. Many people, when they're just getting started, they're not buying 280 unit apartment complexes on day one. I talk to many people that are just wanting to understand, first of all, how to get into the investment market. And what tends to happen for many people, including myself, they tend to look at residential real estate, single family homes, condos, duplexes, small apartment complexes, etc. And so we're just going to talk about that today. I think as you navigate through that, I think you should, first of all, ask why. Why do I want to do this? What is my purpose? And understanding that will start to help to crystallize a path for that. Are you seeking cash flows? Are you seeking future gains with appreciation of a building? Are you seeking the most cash flows? For example, and I'll get to it in a moment, but if you're seeking the most cash flows, that's probably a multifamily unit play or a short-term rental financing play, short-term rental vacation property play, as opposed to a series of long-term single-family homes. But just understanding what it is you're trying to do. What are you trying to accomplish? Are you trying to improve a particular neighborhood? That's a quality idea. Improving particular neighborhoods, offering quality housing for people that are in the rental market. I think that's a quality mission and vision, and understanding what the returns would be for those criteria, for those ideas. So I just think it's important to understand the why, because that will help you start to understand what direction you're headed in. Relating to that, then, what are your strategies? If you understand your why, what are your strategies? What are you interested in learning about? Are you interested in fix and flip properties where you're buying a property that's undervalued in a particular neighborhood? And I've used this in past episodes. If other neighborhood, normal high quality properties are selling for $200,000, but there's a property that is just not up to par, run down, needs a roof, deck is falling apart, whatever, various things happening. The bathrooms haven't been updated in 40 years, etc. that sort of a home is probably not going to sell for $200,000 like the other equivalent well-maintained homes. So a person may be able to buy that sort of a property at less than top market value, refurbish it, add the updates, and instantly upgrade the value of the property and either sell it for a higher value, closer to that $200,000 in my example, or convert it to a quality long-term rental property. And so is that something of interest to you? Dealing with contractors or doing the work yourself? That's a very labor-intensive form of real estate investing. And if that's of interest to you, then the fix and flip space may be the right scenario. Short-term rental vacations have different scenarios. That involves an intense management of that property in terms of the frequent turnovers, probably the higher use of the property, meaning the property may decline in its state. The wear and tear on the property is going to be more intense. Long-term rentals. Are you interested in just steady cash flow with the future gain and appreciation for the sale of the property? Many people discuss the value of multifamily homes, multifamily apartment complexes, because the return for the level of effort tends to be higher, because, for example, it may not take much more time to manage a 6-unit apartment complex than it does a duplex. And yet the cash flows, all other things being equal, will be 3 times for a 6-unit apartment complex compared to one duplex with 2 units. So there are many advantages to that. The other thing that you can do to truly have passive income is to participate in a multifamily syndication property. So that's something, I'll be honest, I've done a little bit of that. I did it, one, to make wise use of the money. The returns tend to be pretty good, and you get access to a qualified manager that can give you some ideas about rental property investment. So I actually have done that for purposes of learning from a professional real estate investor, their ideas and thoughts on real estate investing. A syndication, if you don't know what that means, a syndication is one in which you a professional management company will essentially purchase a property, and I'll just use high-level terms. A property may cost $15 million or $100 million. Let's just use $100 million as an example. The property may cost $100 million. They'll obtain financing from a lender for around $80 million, and they will look to obtain equity funding, partner funding, investor funding for the other $20 million. Put all that together, purchase the property, and for that $20 million investment, which is made up of many people, those people are receiving a return on their aggregate $20 million. Oftentimes you can put as little as $1,000 in or as much as several million, 50, 25,000, 50,000, 100,000, 200,000 is quite common. And you put that money in with the hopes that in 3 to 5 years, you may, for example, double your money. And over the course of that time, they'll start to return your capital, make a return on that investment through the profits generated from the rents and the activities of the multifamily complex. So that's a very high level summary of the syndication investment approach. Again, it's truly passive. You're not making any decisions on the operations of the property. You're just relying on the property manager and the developer and the lead partner on improving the value. Many times the goal is to buy an undervalued property. Through some refurbishments, they are able to upgrade the property from, say, a C level property to a B level property, or B to A, what as it may be, and that will increase rents, which will then drive profits, and then eventually, in 5-7 years, whatever, they'll sell that property for a huge gain, and all those investors that put in the aggregate $20 million in my example will receive a large gain, and then they'll be able to take that money and live on it or reinvest it as they desire. So that's, again, a high level summary of syndication, investment syndication. So those are several ideas as strategies as to what a beginning investor's options include. And my next comment is just understanding where your money is coming from. And we've talked about that before. Think of this as a business for yourself. This is a investment enterprise for you. You're going to obtain your source of funds from 5 places. I'm going to exclude one of them and call them 4, but cash reserves, you're going to obtain your funds for making a down payment, or if you're not wanting to finance, funds for the acquisition from your own cash reserves, from friends and family, borrowing or participating with friends and family. The third option is equity, and that means taking on a partner. And there are pros and cons to that. Cons being that you lose some control, you lose some percentage of the ownership and profits of the return. But some people want that partnership because they want access to somebody that has either knows what they're doing, or maybe they have more funds available. And so there are certainly advantages for taking on a partner in a real estate scenario. Perhaps I've seen many cases where a person will take on a partner. That partner is the money partner. You're the operating partner, and the two of you come together and secure a real estate investment, or it might be the other way around. The fourth source of funding is SBA funding, not applicable in the real estate world. By and large, that's not exactly true. You might obtain, actually, that's not true at all, but in certain real estate scenarios. But in this topic where we're talking about residential real estate investing, it's probably not applicable. And then the fifth topic is, or the fifth source from which money comes from, is credit cards, unsecured lines of credit. And that can be an incredibly powerful way to obtain funding for down payments, and for if you're doing any sort of refurbishment and you're seeking to protect your own cash, or you don't have any cash, unsecured lines of credit is a very powerful way to have to use to access funding for advancing those ideas. So that's something that's very important to understand. I've talked about it before, but it comes up all the time, and it's just so germane to any topic about real estate investing and financing. It's just understanding where you are with the 4 C's. And those 4 C's, again, are credit, cash flow, collateral, and capacity of borrower. So if you are a person seeking to begin doing some real estate investing, and you have a credit score of 500 as an extreme example, you're probably going to need to spend some time repairing your credit and getting your credit to a higher number, as opposed to a person that has an 850 credit score, again, using an extreme. That person, in terms of credit capacity, is well prepared for beginning their real estate investment exercise. So credit. understanding the cash flows and being able to know your numbers, understand what the cash flows for that investment property is going to be is very important. Cash flows. Collateral. When I say that, that's obviously at the beginning is really going to be the acquisition price. Eventually, we can talk about how to use the collateral for obtaining funds for purchasing a second and third property. It's called a cash out refinancing. So after a while, when the property appreciates in value, for example, you may have a debt financing of, let's just say, $100,000. You purchase the property for $130,000. Eventually, that property is going to become worth, again, just as an example, it's going to become worth $200,000. Well, a lender would allow you to do what's called a cash out refinancing to allow you to borrow probably up to, say, 75% of the $200,000. So they would allow you to have a mortgage on that property of $150,000. Let's just say, I think I said in the early in the example that your property is worth $100,000. You can essentially pay off that note with your new $150,000 mortgage, and you take out $50,000 to use for another real estate transaction. That's called cash out refinancing. So I talk about that in terms of collateral and understanding what your collateral is and how to use that collateral for obtaining financing for this acquisition and for future acquisitions. Capacity of borrower is a broad term that I use to talk about what your experience is. Somebody that has purchased 20 real estate properties are going to be looked at differently from a lender's perspective and from a financing perspective than somebody that is purchasing their first property. So just understanding that is important to understand, knowing where you are in the spectrum. Somebody that has purchased 20 properties in the past and has showed a successful enterprise, they're probably, all other things going to be being equal, they're probably going to receive slightly more favorable terms for financing than somebody that is purchasing their first property. There's exceptions to everything, but just understanding that capacity and experience. And the other part of that is down payment. And what is your down payment? And that's another component of the cash of the 4 C's, of the capacity portion of the 4 C's. But speaking of down payment, understanding what your sources, where that money is coming from, where are you going to get it? We talked about the 5 places from which money comes from. Many people think they need to have lots of cash reserves, and that's not necessarily the case. That actually is what holds people up from beginning their investment property exercise, enterprise, and venture. But there are places where you can obtain funds to begin the real estate investing. Many people are accustomed to the process they use to go through their personal residential mortgage, where the banker is the mortgage lender is vetting exactly where that money is coming from. They're wanting to understand whether it's borrowed from somebody else or not. And guess what? In the commercial real estate investment arena, the lender really doesn't care where the down payment comes from, especially in the alternative space. You can borrow those funds from a home equity line of credit. So in that case, as an example, you're borrowing your down payment from your equity in your own personal mortgage, personal residence, and you're borrowing the difference from a lender such that you're obtaining a real estate investment property with basically no money out of pocket. You've used the HELOC for your down payment, and you've used a lender for the bulk of the acquisition. Put the two together, and you purchase the property with essentially no money out of pocket. So that's an idea. Other things include borrowing from friends and family, taking on a partner, as we talked about, and the other thing, I mentioned it earlier, but using a effective business unsecured line of credit program can also be a powerful way to build up an investment portfolio. There are many case studies of people using an unsecured line of credit program effectively to make use of other people's money to make down payments on real estate investment properties. So just understanding that is important. Next thing that I want to talk about is understanding that difference between personal and business credit and personal and business borrowing. Many people are familiar with their FICO score and what that means. And when I ask you what's your credit score, you know what I'm asking. I'm asking for the number that ranges from the low 200s, I think, to about 850, depending on the FICO model. It can be as high as 870 in certain FICO models, but the point is, when I ask you what your credit score is, you know what I mean by that. There is a concept of obtaining business credit that the credit rating bureaus will issue for you and track for you. Dun & Bradstreet has a business credit model called the Paydex business credit. Experian has one that is called the IntelliScore. And those are ratings from 0 to 100. 80 on a Paydex score is equivalent to approximately, I don't know, there's no real rating, but it's considered a quality score. So I put it in the high sevens for a personal FICO score. And that's just my own interpretation. But anyway, the point is that there is a concept of building business credit for which you can obtain financings without the money being reported on your personal FICO score. That's important as we segue into your approach to lenders looking to look for loans. Especially if you go to the banks, and there's nothing wrong with it, and and it just depends on the strategy that you want to take, your financing strategy. But many bankers will recommend you obtaining a conventional personal mortgage for the first few acquisitions that you make for your investment purposes. So, for example, they will allow up to around 10 properties to be purchased using conventional personal mortgages. And the rates will be competitive. The rates will be, they will tend to be the longer term mortgages with low rates. And they'll allow you to do that for a handful of homes. And if you're okay with those funds being reported on your personal FICO, and if you are okay with them being reported on your credit score, and as you conduct other business in your personal life, like buying cars, perhaps buying another primary residence, buying a true vacation property, etc., these properties that you're purchasing for investment purposes will be included in that analysis. People will look at those mortgages and understand whether your current transaction under consideration fits into your credit profile, and whether it fits into your debt to income ratios, and whether you have, in their view, too much debt or not. So, yes, that is an allowable means of financing, but just understand that it will be taken into consideration in other future personal ventures. I personally take the approach because this is a business exercise for me, this is a commercial enterprise for me, it's an investment. I take the approach, I want as little of that in my personal FICO score, my personal credit profile, as possible. I want these to be purchased under an LLC, a limited liability corporation, such that these funds will not report in my personal FICO. They won't show up on my personal credit score. And I want them, because it's economically and intrinsically, these are commercial business efforts for me, and I treat them that way in my financing. So I look for business loans that don't report on my personal credit score. So I think that's important to understand. There's no right or wrong way per se, but it's just understanding what your strategy is, what you're trying to accomplish, and how those two options fit. And it's very important to understand that in my view. Many people will go to a bank, they see the rates, and they don't understand necessarily that those will report in your personal FICO score. And there are other options that are quite economical. They may not be as economical, and as the terms may not be as low as those personal mortgages, but they can be quite economical, and in most cases, well, my opinion is that in most cases, it's worth it to have a higher interest rate, but keep the transaction as a commercial transaction. That's just my opinion, and that's why I'm saying it. What are some of the general terms, just ballpark, just high level? What are terms for, let's just say, purchasing a residential single family home or an apartment complex in the commercial space? Well, again, if you're purchasing that using the personal conventional mortgage, if you've purchased a home, you know about what to expect. Those interest rates tend to be high 2s, low 3%. Maybe they're a 30-year mortgage because they're in that conventional mortgage space. If you buy a single family home in the commercial space at the local bank level, you won't get 30-year fixed rate mortgages. You'll get 5-year adjusted rate mortgages, ARMs, 5-year variable rate notes, where they'll be fixed for 5 years. And at the end of that 5th year, they'll reset based on the current index. And the term, the amortization by which the payment is calculated might be 15, 20, maybe 25 years. In the lenders that I represent in the alternative lending space, for example, most of those lenders tend to offer 30-year fixed rate mortgages. Very simple. 30-year fixed rate mortgages, very competitive rates compared to the 5-1 ARMs or the 10-1 ARMs, where rate is fixed for 10 years. If you're wanting to fix the rate for a long term, similar to your personal mortgages, I think it's a very legitimate way to go, and it's the way I have personally gone in my real estate investment, is to seek out that 30-year financing to lock in the rate. Very, very competitive. Every scenario is different, but I see for a lot of properties, if you're buying a property over $100,000 or more, you can very easily expect to get 3.5%, 3.75% if your credit is on the high side. On the low side, it's still going to be somewhere plus or minus 4%, rounded. And again, it all just depends on each scenario, but that's a broad scenario. I think it's the point I'm trying to make is that you can get a 30-year fixed rate mortgage right now in December of 2021, and markets change all the time, but it's quite common, plus or minus 4% in the real estate space, and that's quite competitive in especially with it being 30-year fixed rate mortgage. But again, my point is just to give you some sense of the options that are out there. Banks will offer rates in the high threes, low fours on a 5/1 arm, maybe a 10/1 arm, but they don't. Also, it's important to understand they won't give a 30-year amortization. It'll be 15 to 20, maybe 25 years. So the payment will be a little higher because the amortization is the payment is based on a shorter time frame, so the payment will be a little higher. But again, there are other reasons why a person may choose that as an option, and that's a-okay. If you're looking to buy a fix and flip property, and this is the one or two last points that I want to make. If you're looking to buy a property where you're seeking a short-term gain by refurbishing the property and selling it for a gain or converting it to a long-term mortgage, the lenders tend to look at that differently than they do a 30-year fixed rate mortgage. Some banks will just look at the total exercise and give funds all up front. I've heard examples where the banks will give those funds all up front. So in other words, there's really two parts to a fix and flip. There is the acquisition of the property. In my earlier example, I said the property would be purchased for $100,000. Then there is the refurbishment piece and needing funding for that piece. And so there's two phases to the financing. So some lenders will gain an understanding of all of that and just give you one lump sum amount, and you have those funds available for the acquisition. And some of the funds will be available for the refurbishment piece. Other lenders will look at those as two different phases. They'll give you, say, 90% of the acquisition. So if you're purchasing it for $100,000, they'll give you $90,000. You would need to come up with $10,000 in some way, either from your own cash reserves, or, as I've said, building an effective unsecured line of credit program to borrow that $10,000. And then you would begin the process of, sorry, you may have heard a dog barking there. Begin the process of doing the refurbishments, and the lender will provide those funds for the refurbishments. Either generally, if they're doing it on a phased basis like this, as opposed to giving all the money up front, they'll do it on a reimbursement basis. But the important thing to understand is that the lender will give, in the fix and flip lender, will give 100% of the refurbishments. And then they'll do that on an interest-only basis. In the non-bank lending scenario, well, they'll give you a fund that you'll be paying interest only as you draw down on the fund, especially on the rehab piece. It's interest only on the amount that you've drawn down, the acquisition plus the drawdown, and that minimizes your repayment. You're not making full principal and interest payments from the very beginning, and you're also not paying interest on money that you haven't used yet that's just sitting in the bank. So there are advantages in my mind to taking that approach, and those types of funds can be secured pretty quickly in a matter of a few weeks, and you can then use that to begin your fix and flip exercise. Again, other banks take different approaches. They'll give you all the money up front, and you begin paying principal and interest and on the full amount, even though it's sitting in the bank and you haven't used it. And there may be reasons for doing that, and that's another option as well. I'm going to end on other things to consider. Remember, this whole thing, I hope it's still resonating, that this is all about helping a beginning investor understand how to get started. And so the last thing that I want to talk about is, what are other ways to get things done? And I want to just talk about if the direct management of these properties or using a management company. And it's important to understand the options there, because if you are going to use a management company, that will involve some costs, and you'll need to take those costs into consideration when evaluating the cash flows of the property, and understanding, again, in the realm of the 4 C's, one of them being cash flows, understanding the costs of using a management company, but also in all cases, there are pros and cons to directly managing or using a management company. And it just depends on your why, what you're wanting to do, how you're wanting to do this, where the property is, et cetera. And I'll just say that it's probably obvious, but if you're truly wanting this to be a passive exercise, then you're probably going to need to hire a management company, because you don't want those 2 a.m, I need a plumber phone calls. But management companies are set up to do that properly, handle that efficiently and effectively. So anyway, just another thing to think about in terms of what you're going to do once you own the property is that how to manage the property. I'm going to end with that. Hope this makes sense. Hope this gives you some ideas. I guess I would also just say, at some point, and I had to do this myself, at some point, figure out a path, figure out a strategy. If you think it's right for you, at some point, you've got to just move forward. Many people and other podcasts say the same thing. People get stuck with analysis paralysis, and they just don't do anything. I think it's important to keep your feet moving, and eventually, if you really think it's right for you, make some decisions and move forward. Find a mentor if you need to. I think that's important, actually. Find a mentor, find some training, but ultimately move forward with it. So best wishes with that. Reach out if you have any comments, questions, if you have some ideas of things you'd like us to talk about, and just move forward and use wisdom, and best of wishes with that. Thanks for listening, and we'll talk to you next time. And this concludes the latest episode of CFO Squared, chats about financial and financing optimization with Karl Baker. We hope you enjoyed the episode. Leave us some notes or comments or questions by reaching out to us via email or phone number. Our contact information is in the show notes, and we would be glad to try to answer questions, take your notes, questions, and comments into consideration for future episodes. Until next time, signing off. Thanks again. Bye-bye.